This is the single most important financial decision you're ever going to make. It's the difference between whether you're going to achieve financial freedom in the next 5 years or 50 years. And ultimately whether you're going to build a fortress of security or a rocket ship to generational wealth. In this video, we're going to discuss the biggest debate in finance: cash flow versus capital growth. Should you be buying assets that pay you every single month, or building an equity portfolio that secures you mass wealth in the future? It's presented as a matter of preference, a lifestyle choice. This is dangerously wrong. This isn't about preference, it's about strategy. And choosing the wrong one at the wrong time is financial suicide. Today we're ending the debate. I'm going to break down with hard data how each pathway works, the brutal tax realities they don't tell you about, and how the world's wealthiest are actually playing the game. Forget what you've previously heard, this is going to be a masterclass, so stay with me. First, let's talk about the siren song of cash flow. This is about buying income. You buy an asset, a rental property, a dividend producing stock, a bond, some sort of monthly income product. And overall it pays you regular cash flow, usually monthly, quarterly or biannually. The appeal is very obvious. It's security. It allows you to pay your bills and expenses on a monthly basis. And overall we're all aiming to quit our 9 to 5, so the more monthly income exposure that you have, the more likely you are to achieve those goals. It feels safe, it feels tangible. It is that financial freedom that we are all aiming for, paid in monthly installments. But here's the catch that the gurus ignore: ultimately the tax man. Cash flow is the least efficient way to build wealth in regards to tax. In the UK, dividend income can be taxed as high as up to 40%. Rental income is added to your overall income and can be taxed at the highest marginal rate. The government takes its cut immediately, before you've even given that money the chance to grow. You're trying to fill a bucket with a hole in it. You're generating income, yes, but you're constantly generating a tax liability. And overall it's acting as a drag on your wealth building engine. It's safe, it's steady, it's monthly producing, but it is slow. Now let's talk about the other side of the coin: capital growth. This is the strategy of buying future value. You invest into assets, into growth stocks, into your own business, and you can still invest into property development for something that you plan on building and to sell at a later stage, not for the monthly income. This is about one thing: compounding. It's about letting your money have time to grow, uninterrupted, unaffected by tax, for potentially years or even decades. You're asset rich, but you are cash poor. Every penny of it is reinvested, like the snowball effect I spoke about in my last video, reinvesting for the future. And the tax efficiency is where it truly shines. With growth assets, you pay almost no tax until the day that you sell. This allows for your investment to grow in its pre-tax full value. A study of US stocks show that historically, value stocks, a proxy for growth, have outperformed their counterparts by 4.4% annually since 1927. That is the price of patience. But this path is a psychological battlefield. It requires you to delay gratification and to sit through volatile ups and downs in the stock market. And you must have absolute conviction in those assets while they pay you absolutely nothing. It's not a fortress, it's a rocket ship. It can either explode your wealth to the upside or it can explode on the launch pad. So which path do the world's wealthiest actually take? Forget the theories, let's look at the hard data. Ramsey Solutions conducted one of the largest researches ever, interviewing over 10,000 millionaires, and the results are shocking. 79% of them received zero inheritance, meaning that they weren't born rich. And 1/3 of them didn't make a six-figure salary in a single year. So how did they do it? 75% of them said it came from one thing: regular, consistent investing over a long period of time. They didn't get rich quick. They used the long-term power of compounding. They ultimately chose the growth path. But that is just your average millionaire. What about the super wealthy? Let's look at a fascinating study at the top 0.1% of the wealthiest. A study from the St. Louis Fed tracked these individuals, the 0.1%, and what they found was very, very profound. They play the game entirely different. The ultra-wealthy hold 85 to 90% of their wealth in equity growth shares. They also save over 70% of their income. Their fortunes aren't driven by their salaries, it is driven by their investment return. They are true masters of the growth strategy. So what does this all mean for you? The debate is a false choice. The wealthy don't choose one or the other. They use both. But they use them in a specific sequence. So let's explore that. Stage 1, the growth engine, for when you're building your career. You have one job, and that is to build your capital base. You are the growth asset. You pour all of your income into the equity markets, constantly reinvesting. You pour every spare penny into index funds, into compounding your business growth. You are looking at assets that are going to be compounding relentlessly. You are asset rich and cash poor, but that's fine. This is where you're supposed to be. Your goal is to build that wealth engine to escape velocity. Then stage 2 is the income conversion, only when your capital base is large enough. Once your capital base is significant, you start to convert small pieces of that growth portfolio into income producing assets. You sell a block of stock to buy a block of flats. You use business profits to invest into private credit. You build your fortress of income after you've built that huge capital base. Growth builds your net worth, and cash flow buys you freedom. You need both, but the order is critical. Stop thinking about it as a debate and start looking at it as a timeline. Are you currently building your wealth engine, or are you currently looking to start buying freedom? Most people start trying to build that fortress first with a few tiny bricks, and then they wonder why they never get rich. The wealthy spend decades building that wealth engine so that they know once it's completed and the capital base is large enough, they can buy as much freedom as they want. Build your engine first and the freedom will follow. If you're wanting to learn more about budgeting, ETFs and investing, then click the free online course in my description. Most importantly, hit that thumbs up and subscribe if you've enjoyed this video, and I hope you follow me for more wealth building tips.